Welcome to Rich Tribe. In this explainer, we are diving deep into how the endowment effect influences what we value. We're starting off with a massive reality check. Holding on to assets just because they are yours is quietly, but constantly draining your wealth.
Wait a second, John. Are you actually saying taking pride in what we own is a bad thing? I mean, whether it's the family home or a stock portfolio you painstakingly built, shouldn't average people value the assets they've worked so incredibly hard to acquire?
It sounds perfectly logical on the surface, Monique, but here is the hard truth of the matter. The market absolutely does not care about your pride. It doesn't care about the sweat equity you put in. Think about it for a second. Have you ever wondered why you refuse to sell a tanking stock? Or why you hold onto a piece of real estate that's just bleeding your cash flow? Or even why you keep a garage packed full of junk? You hold onto it simply because it's yours.
Which brings us to Section 1, the price of attachment.
Okay, I have to challenge you on this, John. If I buy a stock at $50 and it suddenly drops to 40, isn't it just basic human instinct to hold on so I can at least break even? Selling it just guarantees I've lost $10. You want to protect that initial investment, right? Well, that's traditional financial thinking, assuming we all act completely rationally and calculate our margins without an ounce of emotion. But behavioral finance proves human emotion totally warps our reality. You're trying to break even based on your own past reference point. The average mindset says, hey, I paid 50, I absolutely cannot sell for 40. But the millionaire mindset, it is completely ruthless. The millionaire says, the market doesn't care what I paid yesterday. Is this asset worth $40 today? If you treat your assets emotionally, you become utterly blind to their current market value. Literally every single day you hold on to that loser, you are actively rejecting a better opportunity.
Section 2. Defining the endowment effect.
So we call this the endowment effect. Simply put, the very second you take ownership of something, your brain artificially inflates its value. Suddenly, you think your house, your car, or those legacy stocks your grandfather handed down are somehow worth way more than identical ones on the open market. This cognitive bias forces you to pay an invisible tax. You end up rejecting mathematically superior opportunities just to preserve the familiar things you already hold in your portfolio.
But why does our brain play these tricks on us? It just seems so incredibly counterproductive to our own financial survival.
It absolutely is. And this brilliantly illustrates a concept called mental accounting, which is tied right into prospect theory. We put our investments into these little mental buckets. The psychology of investing tells us that the pain of losing a single dollar is felt far more intensely than the joy of gaining a dollar. So investors flat out refuse to sell below what they perceive as the right value. They will stubbornly hold on to underperforming assets strictly to avoid feeling the psychological sting of a realized loss.
Section 3. The sunk cost trap.
This quirk of our brains leads us right into a devastating psychological trap that literally prevents the average person from ever reaching the 1%. The sunk cost trap. Look, a sunk cost is a one-time expenditure of money, time, or even emotion that is completely unrecoverable. It's gone. Yet, average investors treat these past efforts as ongoing investments. I see founders pour millions into failing product lines just because of the initial R&D costs they've already spent. Whether it's a non-refundable fee, a toxic business partnership, or a stock plummeting to zero, people ride out losing situations just to avoid the feelings of regret. They throw good money after bad, just praying to eventually justify that initial cost.
Okay, I totally understand the theory, but what does this actually look like in the real world? How does an average investor differ from someone acting rationally? That's a great question. So think about a simple street vendor. They sell umbrellas when it's raining, and they sell sunglasses when it's sunny. It's a completely rational, emotionless way to protect their daily income. Now compare that to the average retail investor staring at a bleeding red portfolio. Because of familiarity bias, they'll stubbornly hold a plummeting stock just because they like the company's product, completely ignoring the perfectly sunny, profitable opportunities sitting right across the street.
Section 4. Holding on to losers. This brings us to how the endowment effect practically destroys wealth inside a regular portfolio. Financial economists call this the disposition effect. The average investor is completely paralyzed by pride and the fear of regret. They want the immediate joy of a win, so they sell their best, highest-performing assets way too early. But they clutch onto their declining, losing assets for years just to avoid admitting defeat. The wealthy investor does the exact opposite. They divorce their ego from the trade, they cut their losers incredibly quickly, and they let their winners compound over time.
Okay, that makes total sense for a stock portfolio, John. But what about the ultimate middle-class dream? buying a house. Society tells us all the time that renting is just throwing money down the drain, but buying a home is the true sign you've made it.
It's the most dangerous psychological driver out there, Monique. The average person takes 50%, sometimes way more, of their entire net worth and locks it into a single localized asset. They tie their wealth to a single neighborhood's economy, the local schools, the local infrastructure. There is zero diversification. When you combine that massive concentration risk with the deep emotional attachment of the endowment effect, you get people who absolutely refuse to sell, move, or adapt, even when the property becomes a terrible financial burden.
Section 5. Investing like the 1%.
All right, you've successfully dismantled the average mindset for me, John. I can definitely see how pride, fear, and attachment are literally costing us a fortune. But just knowing the problem isn't enough for us. How do I actually break this habit? I want the precise, actionable framework the ultra-wealthy use to allocate capital objectively, without all this emotional baggage.
I'm going to give you exactly that. But before I give you the Millionaire's Framework to eliminate this bias, subscribe to Rich Tribe channel. Like, comment, and share. It's the absolute best way to ensure you never miss these deep dives into the psychology of wealth building.
All right, here's the exact step-by-step framework the 1% uses to override human nature. First up, audit your assets subjectively, not emotionally. Remember, the stock does not know you own it. Second, establish strict, predefined exit points. Use stop losses so the decision to sell is made purely logically before the emotional panic ever hits. Third, rebalance periodically based purely on current market value. This forces you to sell high and buy low rather than drifting along with your biases. Fourth, embrace losses as learning opportunities. A loss is not a reflection of your intelligence, it's just data. And fifth, diversify aggressively across sectors and geographies to completely remove that familiarity bias.
So, the absolutely crucial point is this. The wealthy treat every single day of holding an asset as a deliberate choice to buy it again at today's price. I want to leave you with a final thought to close out this explainer. Look at your real estate, look at your stocks, your business investments. If you had to buy your entire portfolio again today at current prices, would you? And if the answer is no, then why on earth are you still holding it? Master your psychology, master your wealth. Thanks for hanging out with us.